cost segregation study is basically you're taking your existing assets and you're going to accelerate the depreciation way quicker. It's more common on larger buildings. It's less common on single family residencies and multi-units. Now you might say, well, why would I want to do a cost segregation study? Here's what people are not taking into consideration. I know Rafael Javez did some 1031 exchanges in the last 12 months, right? I think Mike Thompson's looking to do some 1031s. Low, we discuss hanging tight right now and then reevaluate in the future. But at some point, you're either going to sell, you're going to pass away and have estate tax, or you're going to sell and pay 1031 tax, or you're going to sell and you're going to do, you're not going to pay tax because you 1031. Here's what happens if you do not do a 1031 exchange or an installment sale. The accelerated depreciation has to be repaid back when you sell the property. So I'm going to grab a quick calculator. I want everyone to do the math, please. This is for you, Kristen. So if you have a $200,000 property that you bought 10 years ago, Dominic's going to write the notes down. You have a $200,000 property. Let's assume that you have a $20,000 land value, okay? So Kristen, you're going to type them in the Zoom chat bar while we do this, please. So purchase price in 2010 is $200,000. You have a land value of $20,000. You're going to depreciate the property over 27 and a half years on $180,000. So what I'm doing is I'm grabbing my calculator. I'm doing 180,000 divided by 27.5. So 180,000 divided by 27.5 equals 6,500, and let's call it 6,550 bucks. I know Rafael Javez will correct me, but that's okay because he went to Stanford and has an MBA. Okay. So with that being said, let's pretend you keep the property for 10 years. So I'm going to basically take 6,500 times 10 is 65,000. I take the 65,000 minus 180,000. Here's my backwards Matt Atkinson math. Gets me 115,000. I add the land value back in of $20,000, yields me $135,000. This is called your depreciation balance, or what your property is depreciated to. Now here's where Dominic's going to come in quick and like Juventus hat. So let's assume that property that he bought for $200,000, even though the ARV was $250,000, because he's smart, he's going to take a $250,000 asset times 3% a year for 10 years. So Dominic's going to give us that calculation real quick. I would expect everyone except Jordy Clark to do this calculation also. So Mike, Rafael, Coco, Lo, Charlie, if you're out in the field, I'm okay that you're not doing that this point. But back to this, Dominic. So if you buy, the value 10 years ago is 250,000 times 3% appreciation over 10 years, which is 2020. You can type in, Dominic, what the current value is, please. And anyone else who wants to can type it in too. I care more about accuracy versus speed. Thank you, Rafael Javez. So I love Rafael Javez, good guy. So now your new value is $336,000. Now, why is this important? Most real estate investors do not understand this when they go and sell their properties. They sell their properties, they then meet with their accountants after, and they're like, oh shit, we did not know about the tax. Okay, this happens all AFT, all the freaking time. Okay, AFT, all the freaking time. So here's my comment. I'm okay that people pull cash out, and if they understand the depreciation and they use that money to buy more assets, I think that's a great idea. Okay, now here's how cost segregation studies work instead. You're going to accelerate that depreciation way quicker. I'm not going to go over the percentage for this exercise. If you guys want, you can contact cost segregation. I forgot what they're called. I'll do a Facebook post and tag them in today. You guys can look at that, okay? But here's what happens. Let's say you buy that single family residency and you do the accelerated depreciation over 7 years. So let's just for fun, this is not correct, but this is just for fun. So let's say you take that accelerated depreciation, this is just for an exercise, 180,000 divided by 7 is 25,771. It's going to fast forward the depreciation to offset some income. Most of the time, here's what will happen. If you guys sell the property and don't do a 1031 exchange and you forgot about it, you're going to pay a ton more tax when you sell if you don't do the exchange. Does that make sense? And a lot of people who are posting, hey, I just bought 10 rental properties and did cost segregation studies and saved $600,000 on my taxes. I just saw that post this week. They don't freaking understand when they sell the property, okay? So what does this have to do with happiness? Everything. What does this have to do with negotiation? Everything. He who has more knowledge and convey it simply can make more deals work. If you guys want to write that down, think about that. The person who has more knowledge and convey it to the seller will make more deals work or flow or create opportunities. So by you guys understanding depreciation, installment tax, this is an awesome time for you guys to buy properties from existing landlords that more are professional landlords that are older. They want the cash flow. They don't want to pay the tax. You can buy the properties on an installment sale, which is taxed differently than selling the property outright and not doing a 1031. So action item number 1 is I want you guys to call your CPA if you haven't already to do tax year planning, but just ask your CPA, hey, if I sold this property for X, and pick whatever property you want. Coco's got one, Lowe's got some. Everyone on here on the call has at least one property, okay? Or has had one in the past. They might have already sold them and paid the taxes. You should say, what is the difference if I sell the property based on my depreciation and pay the tax versus me doing an installment sale, and tell them the price. And you guys can use this example of a $200,000 purchase price 10 years ago with the land value of 20,000. The ARV is 250 10 years ago, so then it's going to go up more. So let's explain with what happens with this. So Coco, you ready? So if we sell this property for 334,000, we're going to use Raphael's numbers because he just did it first. We'll do 336 if that's okay. He always corrects me because I'm always a couple pennies off. So if we're going to do 336,000, let's take 10% off the top for real estate commissions, closing costs, etc. 10% off the top. That's going to get me down to 302,400. Okay. And thank goodness these are recorded so you guys can watch them next month. Now, if you remember, it was depreciated down to 135,000. Do you guys remember that? It's down to 135. That means you are going to pay tax on $167,400. So whatever your tax bracket is, I'm personally taxed as a real estate professional. I'm going to pay a lot more taxes than you guys are, unless your tax is real estate professionals. I bet probably Jordy is. Coco probably is based on her being in real estate. Raphael, Mike, and Lo are probably not. Okay, so these are things you need to take into consideration. Charlie's probably not. So here's the question. If it's $167,400, what's current income tax bracket long-term capital gains? You want to take a stab at it, Raphael? 15%. All right, cool. I just wanted to hear his voice because he's from Wyoming. So let's take 167,400 times 15% is, what is that number for you guys? Jordy, I'm okay that you don't type this in. I got you.
25,000.
So 25,000. Awesome. Cool. Now here's what's happening right now. Thank you, Coco. A lot of people are pulling cash out of their properties and because they're just not thinking of this. I'm not saying it's not good to pull cash out. I'm just helping you guys be aware. They're pulling the cash out and they're not taking into consideration that your property is going to continue to depreciate. So as long as you're aware with that, I love pulling cash out to buy more houses. I've done that my whole career. I recalibrate. I grab my taxes. I grab my cash and I go buy more properties. I buy more, get more cash, and I need to go buy more properties. So when you're negotiating you're with sellers, here's a couple things. If you guys want to write this down to make deals better, Jordy, is that a good enough explanation about cost segregation and depreciation? Oh, we lost them.
Yeah, can you hear me?
Yes, I can hear you.
So it's pretty much exactly what I was understanding, and I plan on swapping until I drop with these properties that I was going to cost segregate.
Please explain what swap and drop means for everyone else.
Do a 1031 exchange until you die, at which point the current tax code allows a stepped up basis, meaning you can depreciate your properties, let's call it to zero. And then if you pass away and do your estate planning properly, it would go to your estate and they would be taxed based on the current value and how long they hold it. So if they liquidate when I die, they would not pay any taxes.
Cool. So I want to live for a long time. So let's just make a quick assumption. Do you guys know that Biden wants to get rid of 1031 exchanges? So that might go away.
That's been the rumor.
Yeah, that's what's printed. So that's from him. So here's my comment with that. I personally don't love doing cost segs on my rentals right now because I don't need that losses. I would, based on planning, let's all assume, if you guys want to make this in a positive way, let's all assume we're going to make more money in the future. Therefore, we want more deductions moving forward. I don't want to take them this year, Jordy. I don't want to offset a bunch of my stuff. I want to keep building up, and then make some modifications. Most of the people that I know that are less experienced are cost segging way too much because they're only thinking about right now. They're not thinking about 3 years down the road, 5 years down the road, 10 years down the road. If I did cost segs on my cost segregation studies on my houses built in 1930s, that's old and literally a piece of shit that I need to sell, like that really is not going to do much for me. I'd rather use that, do a regular 1031 exchange, buy something newer, buy something that cash flows, or buy in a better area. You guys want to write that down? When you 1031, you want to buy something newer, something that cash flows better, or something that's in a better area. Ideally, you want all three. So great example. As you're negotiating with the seller, you're going to sell, there's three different types of people you're buying from, right? Professional landlords, professional investors, accidental investors, or burned out. That's it, right? An inheritance is an inherited one. A burned out one is a burned out one, or a professional. If you guys can talk the same lingo, I bought 4 properties from Matt Sneed 4 or 5 years ago. He posted on Facebook. He could have sold to anyone. He sold them to me because I understood exactly what they were needing to do, and I gave him consulting on it. Therefore, he sold me the 4 properties, and you guys walked him 2 years ago on Goshen Street if you guys went on the bus tour, because those are 4 properties on one street, right? It's all based on relationships, and I could give him more than not the price, but to help him get what he's looking for. So if you think about this.
So can I ask a question, Matt?
Yes.
What I'm hearing you say is you are paying taxes now rather than cost segging in 1031 anyways, because you anticipate to continue to earn more money in the future than you're currently earning. Is that?
Yeah, oh yeah, yeah, absolutely.
Okay. So your recommendation would be don't cost seg, still roll up, rather than accelerate that depreciation now and buy more properties now at ultra low interest rates. Is that right?
So, well, you added 3 things onto it. So let me share something. I'm not doing cost seg studies now because I know my income will, as long as I'm alive, my income will continuously go up. Okay. Or if I go to prison, which I'm not planning on doing that one. And we're not talking about spirit prison. We're talking about prison with 4 walls that Dominic talked about today. Okay. So with that, the next comment is, as my income continuously goes up, I want to carry those things to my benefit in the future. Dude, you're not making 500,000 AGI this year, right? Most people are on this call are not doing that. Okay, good job. Then we'll talk about some more consulting to help it offset your expenses. Okay, with that being said, I'm planning on the future. When I first started, I expensed everything after 3 years of taxes, and then I couldn't get qualified for mortgages, and I still made really good money. But I was also spending $35,000 on rehabs because I didn't know any better, right, until 2007. So I'm compressing this learning curve for you guys. So I would still 1031 exchange. I would still buy in a better area, better cash flow, or a better property than what you're selling, and you're going to get that financial freedom that you guys are looking for.